Hey traders, Raghee here, and in this free recap video, let's talk about crude oil. So first of all, I want to just remind everybody that we're in that 2-week window between the September to October rollover. So we are potentially in the window for some what I call rollover shenanigans. Now, let me talk about rollover with you all just for a moment, for those of you that are not familiar with this concept and what it's going to potentially mean. So there's really only two kinds of gaps on a chart. We call a natural gap and a rollover gap. And it's very common for most markets to have what we call sort of an upward curve, which is to say the further out you go in the contract months, the higher the price is, right? But you'll notice where we are on the current October contract month and the current September. Well, this is the front month. September is the front month. We're sitting at about 78. This is sitting at about 09. So you see that's about a 70-cent difference. So that's what you're dealing with right now, a 70-cent difference between the two contracts. This will be important in a moment. So as we get closer and closer to the rollover, with October is going to be the front month, and September just kind of rides off into the sunset. We're going to see the market have to adapt to the new price. Now, crude oil very often goes into backwardation, which is this kind of trajectory. In other words, the further out you get with the contract month, the lower the price is. All right, now that doesn't necessarily matter at the moment for our purposes. What I want you to understand is there is a 70-cent difference between these two contract months, and that would mean the day when the charts roll over to October, or the V contract, they're going to be plotting the October prices. And that means there's going to be a 70-cent difference in price. And that means there's going to be a gap down of 70 cents, or whatever that number is, the closer we get to the actual rollover date, which is, I think, 13 days away from today. So there's no news or anything, but you're going to see a gap down because that's where October is trading as compared to September. 70-cent difference. So this is not something that I'm necessarily super concerned about at the moment, but if you are long, you've got to think about this. You've got to think about what would happen as we go from September to October and what that price differential is. All right, that's the rollover gap. And again, we are in what's known as backwardation, where the further out in contract months you go, the lower the price is, as opposed to contango, where the further out, the higher the price is. So kind of an upward slope versus a downward slope. Now, what about crude oil today? Crude oil had a interesting set of events, and I'm going to walk you guys through them right now. And we're long crude. And that is, number one, we have the API to EIA, which is the phenomenon we see every week, the Tuesday after the closed release to the Wednesday 10:30. The timing is very repeatable, right? We always want repeatable setups. Repeatable events, repeatable setups, because then you have some consistency, a system or a methodology to your trading. Remember, and I love this saying, losers have goals, winners have systems or methodology, okay? Now, the other thing that I'm looking for is an extended exhaustion level. Because I have a bullish bias, I'm looking predominantly for the buy. Doesn't mean I'm going to be buying at current levels. It means that I'm going to be waiting for that exhaustion level. And the way we calculate it is using the price movement ranges. Now, just so you guys know, this is going to be something we're going to be talking a lot more about in the coming weeks and into September, where I'm going to be teaching you guys a whole lot more about how I trade options with price movement ranges, how I buy out of the money puts and calls around earnings with price movement ranges, how we day trade with price movement ranges. This is a core component of my system, of my methodology. Even though I widely consider myself a discretionary trader, I do have a method, right? And this is part of it. So we look at the high of the day, we subtract the price movement range, and the level that we came up with today was the 50-cent level. I mean, on the money, it was 66.50. It might have been 52. And so that becomes where we're interested in ultimately trying to identify if there's a low and whether or not we can buy. And we end up buying in this area. Okay, but what I want to take away, I want you guys to take away from this conversation is we didn't buy here, We didn't buy as the market was heading lower. We didn't just randomly try to pick a level. We calculated a level based upon a 32% probability because the prices got pretty wild. But we looked for a very high probability of why the market would stop in this area, coupled with the fact that, frankly, it's done it before. Okay? And that's how we got long. And that's a very simple look at how we took advantage of an expected volatility event, projected a low, and bought it. Now, for some traders, this is an easy 40-cent win. For others like myself, I'm looking for a trade like this that we executed once before to head up into a similar area around the 69.80 area. And that's really the target. I might be a little bit more, because we seem to be very choppy here, I might look for something more along the lines of maybe 67. We'll look around 68.97, 68.95. I might look for something like that as opposed to the 69.80 area. But I'm definitely looking for more upside here off this oversold level. Hope that was helpful. Think about again, winners have systems, losers have goals, okay? So we want that system, we want that methodology, and it's got to be repeatable. All right, gang, have a great one. I'll see you in the next update.